Ladies and gentlemen, thank you for taking the time to be with us today for the M&A Academy program and our seventh webinar in the 2025 series. My name is Vidushi Gupta and I'm a partner in Khaitan and Company's corporate M&A group. I would like to extend a very warm welcome to this webinar to every one of you, whether you are in our audience in India or around the world. The M&A Academy program is designed to provide foundational legal knowledge and understanding on M&A transaction and processes to anyone interested in M&A in India. Our subject today is managing risk in private M&A. In this session, we will have a panel discussion followed by a Q&A. While we have already received several audience questions, if you do have questions, please submit them using the facility provided in the webinar portal. You can either address them to a specific panelist or leave it open and I will then pick up one of our experts. If we cannot cover all questions during the webinar, we will respond offline by email after the webinar. Also, please note that summary notes of the discussion and a recording of this webinar will be sent to you after the webinar as a matter of course. India is experiencing a massive growth in M&A transactions. And M&A is an important part of our firm's practice with more than 50 partners dedicated to this area. Today, the speakers will share their insights on effectively navigating and managing risks in private M&A transactions. As deal activity continues to evolve in a dynamic legal and commercial environment, ensuring proper risk allocation has become more critical than ever before. This session will explore practical strategies for identifying, mitigating, and allocating risk through legal structuring, robust due diligence, carefully negotiated warranties and indemnities, and the increasing use of insurance tools like warranty and indemnity insurance. Everyone who's registered for this webinar should have already received by email a summary of the speakers and their credentials. So I will not spend much time introducing them here. Suffice to say that they are M&A experts and the right people to be speaking to us today about this topic. Our panelists today are Aditi Singhvi, Aditya Patni, and Nitish Goyal. So let's get started with the questions. The first question I would like to pose to each of the panelists as we are just starting the conversation, and this is the most important one. So what do you think are the most common risks in Indian private M&A deals? Aditi, if I may start with you.
Oh, good afternoon, everyone, and thanks for kicking off the discussion, Vidushi. One of the most common risks, which is also very typical of the Indian M&A market, is a complex regulatory regime which involves approvals and compliance requirement. We have various regulatory bodies, such as the antitrust regulator, which is the Competition Commission of India. We have Reserve Bank, we have SEBI, and then we also have certain sector-specific regulators. If there are delays in getting the approvals or clearances from these regulators, they can disrupt the deal timelines that you are looking at and often, of course, completely derail the deal. These regulators have standard operating procedures, the way they look at their application, and how they are going to give you that approval. So the key is to get the right experts onboarded from the very start of the process, get the right lawyers and the other advisors who have scars on their backs dealing with such applications regularly, and align all processes and intimate internally on what may be the potential questions that can come up. The other regulatory consideration is the foreign exchange control regime in India. There are certain sectors which have sectoral caps. There are restrictions in certain sector on foreign direct investments, which always drives deal structuring. For instance, if a non-resident company is looking to acquire a brownfield pharmaceutical unit, it's potentially, you could face an FDI cap, which could potentially lead to you figuring out different structure. If you need to, for example, close the deal sooner, you may need to do a tranche buyout. I have a lot of other risks I can highlight, but I'd give it off to Nitish to chime in with this experience.
Thanks, Aditi. Thank you everyone for joining us for this webinar. So some of the key common risks that I'd like to cover, one being title issues. Title issues are fairly common in M&A transactions. It depends on what kind of a transaction you are looking at, whether it's a share deal or an asset deal. wherever whatever main asset that you wish to acquire, it is very important to verify that asset has clear and marketable title. It's important, especially in entities which are heavy on real estate, to do an encumbrance check to verify that that this title is defect free, because otherwise this can really affect the valuation and in some cases even halt the transaction altogether. Another key area is legacy issues of the target. In some cases, we have seen that there are several pending disputes involving the target company, and purchasers can inherit these substantial liabilities if these are not diligenced properly and proper mitigation steps are not taken. Another key common risk that we have seen is lack of documentation. In most cases, it is very important that the sale and purchase documentations are properly negotiated between the parties. The transaction documents are tailored to capture all protections that the buyer needs, and adequate recourse mechanisms are inbuilt into the documents. I'd like Aditya to chime in with some of the common risks that he has seen.
Yeah, thanks, Nitish. Hello, everyone. I'd say one of the most underestimated risk is tax exposure, not just the cost, but the uncertainty and exposure to litigation. We routinely see three categories of tax risk in Indian M&A. Firstly is the structuring risk. India offers multiple deal structures, whether it's a share purchase, whether it's a business transfer, the slump sale, or an itemized asset sale, mergers, demergers, each with their distinct tax implications. A small miscategorization, such as misclassifying an asset sale as a slump sale, could have serious repercussions in terms of applicability of GST liabilities, which were initially not planned by the parties. Also, commonly due to valuation mismatch, parties end up agreeing on earn-out structures, taxation for which is again quite tricky, and such transactions need to be properly structured for tax optimization. Secondly, I would say documentation and eligibility risk. So, for example, demergers need to meet specific legal tests in order to be tax neutral. If liabilities are incorrectly apportioned or qualifying conditions are missed, the tax shield could vanish. Thirdly, I would say post-closing scrutiny risk. So, tax authorities are most active than ever, questioning everything from valuation, indirect transfers, beneficial ownership, treaty eligibility, and this is especially more visible in cross-border deals. So the takeaway, therefore, would be to involve tax advisors early on, right at the structuring stage, and not really after signing. With that, over to you, Vidushi.
Thank you so much for this wonderful kickstart. And let me delve deep into the topic now. So, Nitish, if I may ask you, how should buyers approach due diligence in India to uncover hidden risks?
Yeah, excellent question, Vidushi. So, in most cases, we have seen that, the M&A transactions are usually a ticking time bomb. The buyers want to close the transaction as quickly as possible. So they come to us after they have negotiated a term sheet, and then and they want to dive into the definitive documentation while doing due diligence in parallel. And usually the task given to us is to wrap up the diligence as quickly as possible. But that's really not the right approach. We always recommend to the buyers that they should adopt an exhaustive, a multidisciplinary, and a tailored strategy to do due diligence. Why that is important is because that's really where the buyer gets to know how uh, about the business of the target, and whether the level of the status of their compliances, and what risks that should be mitigated as part of this deal. So just to dive into the aspects of due diligence that should be covered in any M&A transaction, first and foremost, legal due diligence, which should cover the compliances with all sector specific regulations, all licenses, registrations being in place, thoroughly check any pending litigations of the target, their documentation as far as their related party transaction and so on and so forth are concerned. Another key area of diligence that we always recommend is a tax and financial due diligence. so tax experts should be involved for scrutinizing the tax filings of the target, their outstanding liabilities, all their past tax assessments, and ongoing tax disputes. And that's a key area because more often than not, we've seen in post-closing phase that the past tax non-compliances of the target entity are inherited by the buyers. Another key area that we have seen more often being used by the buyers now is ESG diligence. So this is really an environmental, social, and governance aspects related diligence. This is especially important in those targets where environmental compliances are necessary, and ESG is increasingly material to valuation and can have a reputational impact for the buyers. So in sum, what I'd recommend, a robust multidisciplinary due diligence process is best for buyers to avoid surprises later and safeguard their interests from the get-go.
Thanks, Nitish. And like you said, so many times it takes time to make the parties understand why diligence is important. Otherwise, lawyers are got into the transaction quite late, and then there's not enough time to conduct enough diligence. So well put. Thank you so much for that. Aditi, let me come to you, and I wanted to touch upon how to manage title risk in shares or asset acquisition, depending on what kind of transaction we're looking at.
That's a critical question, Vidushi, because at the end of the day, what you're getting is effectively the shares if you're doing a share purchase with the assets, and if you're doing asset acquisition, then the individualized assets that you are purchasing. First, like Nitish said, due diligence is your best friend here. And like you were mentioning, that often we are got into the process much later, so it becomes a difficult task for us to do a thorough job. I think to that we should tell our clients that due diligence is like actually dating. You want to know everything before you commit, otherwise you'll be in for some very awkward surprises later on. So going back to it, when you're looking at due diligence for shares, it's important to trace the entire chain of ownership, look at encumbrances created, check for the certificates. We are moving to a dematerialized regime now, so we need to look at how the records are reflecting at the depository participants' end. You have to do a very clear cut, thorough job on examining the corporate approvals at the time of issuances and at the time of transfers. If it's a cross-border deal, important to look at all FEMA filings to ensure it doesn't create any issues for your subsequent sales and to complete your regulatory filing for the sale that you are looking at. Don't just take the seller's word for it, examine public records. And this goes to say for real estate property as well. A 30-year title search for a land parcel is becoming the norm increasingly. What's important is a verification of records at a sub-registrar's office. So you miss any nasty surprises later on to find that actually the key title deed had not been even registered with the sub-registrar. Now, this is just the step one. Once you've identified, and there will obviously be some risk that you come across, it's crucial to negotiate reps and warranties along with indemnities that have clear caps and time limits, which give you sufficient comfort. I think the panelists will be speaking a little bit more about this. So I will, on this point specifically, I'll say that just don't wait for last minute to get the disclosures. Push for them early in the process. And to give you example, in one of our deals, the seller decided to give us a revised disclosure letter at the nth hour. And sure enough, it had so many issues that it kicked off a whole new work stream of diligences. The other options you have is escrow accounts or title insurance, which we will talk again a little bit more in detail later. While these are not widespread, they are gaining traction and they are a great mechanism for getting you an extra layer of protection rather than just rely on the seller's word. One final point is that if you do find issues in diligences, just make sure they are addressed as condition precedents in your documents or address them through post-closing remedies. With that, back to you, Vidushi.
Well put, Aditi, because when we are talking about title risk, it can really be a red flag in our diligence report and it has to be taken care of adequately in the documentation. Thank you for that. Aditya, you touched upon the tax issues, and let me ask you that what are the typical tax risks that you have seen in M&A deals while conducting diligence or otherwise?
Yeah, thanks, Adushi. As mentioned earlier, the Indian tax landscape is a bit of a minefield. So if you don't navigate it right, you may find that the deal that you closed last quarter is still open in the eyes of the tax authorities. So from an acquirer's perspective, here are the key tax risks that we see repeatedly. I would say indirect transfer tax is one of the most high profile tax risks, especially in cross border deals. So, for instance, if you are acquiring a foreign company which derives substantial value from Indian assets, the Indian tax authorities may claim a right to tax such a deal, even if the transaction happens offshore. A case in point could be Vodafone's US $2 billion plus tax demand from a Cayman Island deal, which was actually followed by a retrospective law change. And then, there is also Cairn Energy's US $1 billion plus tax demand. And even today, the challenges persist, such as, there are valuation disputes on measuring substantial value, tax treaty eligibility, and withholding tax dilemma continues to evolve. So that's something to be mindful of. And secondly, I would say many acquirers underestimate the risk of historic tax compliances. So it could be, in the form of GST, service tax, TDS, or even employee taxes. If these are not properly paid or disclosed, the liability will transfer and compound over time. So, for example, in one of the mid-market deals that we were involved in, the buyer actually uncovered a 14 crore demand and denied GST input credits. This was essentially due to a vendor error from 3 years ago, and this was never found out during the diligence process because that was a red flag diligence, and they never looked into this and not specifically covered under transaction documents. um, Thirdly, I would say withholding tax is another flashpoint, especially in cross-border deals. We frequently see misapplied treaty benefits, missing tax residency certificates or conditions attached thereto, payments made without proper PE risk evaluation, or treatment of earnouts and timing of tax in relation thereto. Of course, there are several other structuring issues, such as successor liabilities. Even in asset sales, continuity of business can actually trigger a successor liability. Lapse of tax losses. If there's a change in shareholding above 49%, the tax losses could lapse. Then there is guard. If the structure really lacks commercial substance, the tax authorities in India can actually disregard it, and so that's also quite important to account for. Uh, I think I can provide a practical playbook perhaps to better manage tax risk at a broad level. And that would be, going deeper on tax diligence, not focus on just red flags, but look at patterns. Of course, we mentioned this before, but involving tax advisors early on, and especially relevant for treaty heavy or cross border structures. Using expert opinions or pre consultations, clearances wherever possible, negotiating protections, whether it is escrow, indemnities, warranties, they must align with the actual risk that deal presents. And I would say post-deal compliance check, especially around GST, TDS, transfer pricing, employee taxes, etc. With that said, back to you, Vidushi.
Thanks, Aditya. I see there are a lot of tax risks which, when we are just focusing on legal diligence, we may not be aware of. So, a specifically focused tax diligence is absolutely necessary. And Nitish, I wanted to also touch upon if there are any specific risks when you diligence a big conglomerate or a promoter control target. So, if you could throw some more light on that, please.
Sure, Vidushi. So, where the transaction involves group companies or promoter control targets, there are several unique risks that require heightened attention from the buyers. Some of these include, firstly, that these businesses we have often seen have extensive related party transactions. Those transactions may not be on arm's length, and that results in conflicts of interest, potential fund diversion, or hidden liabilities. There are certain risks such as inflated revenues, siphoning of resources, non-compliance with disclosure requirements, and these may not be immediately evident to the buyer. So it is very important to do a deep dive into these kind of transactions because there are usually masked through complex ownership structures and opaque financial arrangements. Just to give you an example of these kind of related party transactions, we've seen instances where there are management contracts with the promoters where they are taking some consultancy fee from the company, which may not be where essentially services are not being provided, or these are just mechanisms to take certain money in pocket of the promoters. Another example could be where the assets, like for example cars, may be used in their personal capacity, but those are taken in the name of the company. So these kind of issues you've seen often happening, and where these kind of related party transactions can lead to erosion of value in the company. Another issue that we have seen in these kind of scenarios is lack of corporate separateness. So often we have seen that the boundaries between entities are blurred, personal and business interests are intertwined, and the assets of the businesses may be commonly used between different promoter group companies, or the employees may be shifted around depending on requirements between different entities. So it becomes very important for buyers in these kind of businesses to really separate the assets and employees wherever they are putting value, so that clearly these kind of assets can be clearly delineated and moved into the target. I'll give you an example of this. We've often seen that the key trademark, which is relevant for the buyer, may be with the promoter, maybe with another promoter group entity, and may not be with the target. So it is important to ensure that the assets that you are paying value for are housed in the correct entity. The last point I'd make is certain informal arrangements where the supply chain may be dependent on promoter group companies, and this can really disrupt business continuity post closing because you are still in some ways dependent on the promoters. So it is important really to ensure that you are buying a standalone company which can have its own supplier base, the employees, assets, etc., so that you are not inheriting any legacy issues from the promoters. I hope that
Thanks,
answers that.
Nitish. Yes, absolutely. And I'm glad you gave so many real examples, which we do see in so many transactions where everything's related. A is related to B, B is related to C, C owns the entire company, D. So, so many intertwined transactions. And these issues become really important, and I would say more important when we are talking about 100% acquisition, or when the company is totally getting out of that group structure. So thank you for that. Aditi, I'll come to you now, and I want to talk more about earnout. And if you could tell us, how should earnouts be structured to avoid disputes?
So, Vidushi, earnouts are increasingly becoming a very popular M&A tool to bridge valuation gaps between sellers and buyers. Essentially, they allow the sellers to get paid more if the business performs well post closing, and the buyers to help manage risk if the performance falls short. To avoid any disputes, the key is to structure any earnout mechanism with crystal clear terms. First, you should define the performance matrix precisely, whether you're going to examine the EBITDA of business, the net worth of business, the net profit, revenue, whatever be it may, has to be clearly set out in the transaction documents that you're putting in place. For example, if EBITDA is the metric, then the agreement must specify how it's going to be calculated, including treatment of extraordinary items, what provisionings are allowed, and what accounting standards you're going to apply, whether it's going to be GAAP or Ind AS. Ambiguity is what causes the biggest disputes. Second, also have clear time periods with the reckoning period for which you are going to examine these performance metrics. and if there are going to be threshold or there's going to be sliding scale of payments. So you may have payments which are linked to EBITDA if it exceeds a certain limit and then increase proportionately beyond that. Third, it's important to consider and evaluate who controls the business during the earnout period. Typically, it's the buyer who takes up control post closing, so the sellers have to negotiate very strong anti asset stripping clauses to avoid devaluing the business. Examples are restriction on selling key assets, incurring unusual expenses, diverting cash flows. Fourth, it's important to agree on proper reporting and audit rights. The seller should have access to the financials of the company. When the calculation for earnout is presented, they should have the ability to audit it. Finally, disputes can, of course, still arise, and they often do so. So it's very vital to include a dispute resolution mechanism, one which can help address the dispute in a very speedy manner. Many deals we see independent expert, often a chartered accountant, which is appointed, which will give binding determination on the calculation, setting a clear timeline for the resolution also helps ensure that things don't get prolonged at all. To illustrate, in one of the deals, we have seen like a vague EBITDA definition leading to a 3-month tussle between the buyer and seller post closing because there was a disagreement on whether or not to include one time expenses. In another one, the buyer sold off some valuable assets which reduced the earnout payments because the anti stripping provisions weren't strongly worded. But no, everything is not as dark as they're making it out to be. There are earnouts which flow by very smoothly. In one of our recent transactions, we saw that the buyer presented the earnout calculation, which led to no earnout payment, and the sellers didn't have to dispute it at all because there was no basis since it was so crystal clear. So trust me when I say that now we have the buyer as the client for life. In short, they are powerful and complex tools, important to just get your advisors, both legal, financial, early on in the process to help draft a watertight earnout structure. With that, I'll hand it back to you, Vidushi.
Thanks, Aditi. So basically, we have to ensure that earnout mechanism is properly and clearly laid out in the documentation. Thank you for that.
Absolutely.
I also wanted to touch upon foreign investment restrictions because so many times we are advising our foreign investors. So, Aditya, if you could help us understand how do foreign investment restrictions impact deal structuring?
Yeah, thanks for that question, Vidushi. I think foreign investment rules in India don't just sit in the background. They often shape the deal itself. So affecting everything from control rights, valuation, timelines, and even feasibility. Aditi mentioned earlier FDI and different entry routes. So, for example, under the automatic route for FDI, no prior approval is required, but there's also the approval route, which requires a prior government sign off or approval, depending on the sector and the conditionalities. But here's the catch: approval timelines can be opaque, slow, and unpredictable. So, for instance, we were advising a PE fund on a 100% acquisition of a brownfield pharma company. And FDI, of course, is only allowed up to 74% under automatic route, and anything more required a prior government approval from the Department of Pharmaceutical, which could have been a deal breaker because the sellers were not looking to wait that long. So the PE fund actually partnered with an Indian co-investor for the remaining 26%, and they could close the deal. And as regards managing control, that was managed through the shareholders agreement. As a result, I think the approval bottleneck was avoided and the deal could be consummated within the commercially agreed timelines. You'll see similar workarounds, in other sectors. For example, in e-commerce, where FDI is inventory-led models is barred. Another important aspect to consider is, FDI regime is quite dynamic, and therefore it's important to check the latest policy which may apply to the sector that you're looking at. I'd also like to touch upon Press Note 3 of 2020, commonly the PN3 condition, which essentially prescribes a prior government approval requirement across sectors if the investor is from, or the beneficial owner of the investor is from a country that shares land border with India. So the beneficial ownership test is also a gray area, often triggering scrutiny for even minority LP stakes. And although this was targeted at China, its impact has been much broader. So, for example, in one deal, a Singapore-led lead investor had a Chinese LP with around 12%. But this actually triggered a PN3 approval requirement, delaying the deal by many months and forcing the target to actually get into a bridge round. So I think there are of course additional constraints that also include things like what instruments you can invest in. So only fully convertible instruments are allowed. No hybrids are permitted. Pricing rules apply. So any foreign investor before investing has to ensure that the price that they're investing in is compliant, and it's supported by a valuation report by a registered valuer, which is not more than 90 days old. There is deferred consideration is regulated, so it could not it cannot exceed 25% of the deal value or 18 months from the date of the agreement. FEMA compliances, foreign exchange compliances, is quite critical. For example, if even if a simple filing from the past is missed, that can actually block the transfer in the future of those shares as well. There are other things like downstream investments, which is essentially if the foreign investor has already an existing Indian entity and they want to use that Indian entity to make further acquisitions in the Indian market, that's known as downstream investment. This again is quite regulated, and funds have to be bought in from abroad, or you could use internal accruals, but you cannot leverage funds from the domestic market. With that, Vidushi, I'll hand it back to you.
I'm sure, Aditya, it was very difficult to answer in such brief timeline all the foreign investment restrictions. It's practically impossible, actually, but you have done a good job there just to highlight the key points. And with that, I actually want to move to a very, very highly negotiated topic, which is indemnities. I can tell you in deals, most of the time is goes into just negotiating indemnities, the limitations. So, Nitish, I'll come to you, and if you can tell us what is the role of indemnity in risk allocation.
Yeah, thanks, Adoshi. Like you rightly put, I think that is the most hotly debated topic in any M&A transaction document. And why that is so is because it plays a critical role in risk allocation in M&A deals. For the benefit of our audience, indemnities are basically contractual promises by the seller to compensate the buyer for specific losses or liabilities that may arise after completion of the transaction, and to put the buyer in the same place as if they were, had the seller not have breached any representation, warranties, or covenants given in the transaction documents. So, and a question may arise that we have been talking about doing due diligences through this webinar. So if the buyer has already undertaken a robust due diligence, then what is the requirement of really negotiating an indemnity as well? Because now they should be aware of everything as far as this target is concerned. But still, indemnity is essential for a buyer to negotiate. Why? Because even with a reverse due diligence, the risk may not be fully quantifiable before closing, or new information may arise post closing which the buyer may not have been aware of during the pre-transaction phase. And a well-drafted indemnity can provide a recourse to the buyer, allowing them to claim compensation for the losses suffered due to past breaches of the seller. This really helps in preserving the deal value for the buyer and protect them from any post-closing liabilities. An example to drive this point home could be that even during the due diligence in one of our deals, we did figure that there has been already a decree passed against the seller, against the target, in fact, for a past claim. Now, an obvious answer or a mitigating step for that will be that you do a purchase price adjustment for that, because this is a known risk already, and payout has to happen from the target. So while we did that, but we also advise the buyer to claim an indemnity for any future losses that may arise as part of this litigation. And lo and behold, after the closing, the counterparty to that litigation did actually make a claim for some residual losses that the lower court had not ordered them. And and for that purpose, the buyer did have an indemnity shield in the transaction documents, and they could protect themselves for the future losses that arose because of this litigation. So this is one of the ways in which indemnity can protect you even for known risks as well as for unknown risks. So, for example, for any of these pending tax notices or regulatory actions or any past non-compliances of the buyer, the seller, sorry, the buyer can claim an indemnity from the sellers. So, in summary, indemnities are fundamental for allocating liability for known and unknown risks of the target, and they effectively serve as a backstop against any post closing losses and ensure a balance of risk between the parties.
Right. Thank you, Nitish. Actually, when we are talking about indemnities nowadays, we've also seen warranty and indemnity insurance products being used. But Aditi, if you can tell us, you think these products are widely used in India or they are still being used in a limited manner?
Yeah, no, great question. W&I insurance or warranty and indemnity insurance has clearly moved from being a novelty to a real deal enabler in the Indian M&A market. Essentially, it protects against unknown breaches of representations. Basically, if something undiscovered emerges post closing, the insurer steps in, letting sellers walk away clean while buyers still retain recourse. Now, is it widely used in India? I would say yes, but selectively. Initially, it was driven by PE exits. It's now used in competitive auctions, cross border deals, even purely domestic transactions, but it's not a magic stick. Typical standards still standards of exclusion still apply. So for example, any FDI, FEMA non-compliances or anti-corruption, environmental issues, or for instance any known issues from diligence or any sector specific issues, which the insurers consider relevant, they are typically excluded. And tax risks of course can be covered, but do expect to see a higher premium and retention, especially when you're taking an aggressive position. On the commercial side, I think premiums have currently in the range of 1.5 to 2.5% of the coverage limit. Retentions we're seeing at the range of like 0.5 to 1% of the EV. But conditions like full scope diligence, clean disclosures, and zero surprises still apply. Underwriting is quite detailed, so they will underwrite your diligence, and sometimes it may feel like they'll underwrite your emails too. But on the positive side, claims are rising, especially around tax and regulatory issues. India now accounts for nearly a third of W&I claims in the Asian markets, and insurers are still paying out, but the underwriting is getting more tighter. I hope this responds, to your query, Vidushin. Back to you.
Absolutely, Aditya. Thank you so much. I think now, like you mentioned, that premium has also come down a little bit. That is also kind of boosting the WNI insurance products. Thank you. I think one last question I will ask Aditi before I move on to the Q&A. Aditi, I wanted to touch upon escrow and holdback arrangements. So if you can let us know what are typical escrow or holdback arrangements that you have seen in Indian M&A transactions.
Thank you for that question, Vidushi. Escrow and holdback arrangements we are seeing increasingly being used to secure indemnification obligations, ensure post-closing adjustments, and address certain other risks such as the litigation issues that Nitish mentioned. That if you know there is a litigation which will play out soon after closing, best to have that amount set across in form of escrow or holdback to address it effectively. There are also closing escrows which are becoming increasingly common, specifically in cases where there is a counterparty risk of actually going through with the commitment of transaction. if in particularly where you have a longish time period between signing or closing because of various regulatory approvals. Now, let me start with distinguishing the two. Escrow involves a neutral third party. You will usually have a bank or a financial institution which will hold the money for a defined period, and the release mechanisms will be clearly negotiated in a document. Holdback is simply when the buyer keeps a portion of the purchase consideration for itself without involving a third party. Holdbacks, though they are very simple, they tend to be more riskier for the seller. If I may add on a lighter note, think of escrow as a trust fund that is created by parents that's there to protect the child, but you cannot dip into it whenever you want. Typically, we see the amount held in escrow in Indian M&A deals ranging from 5% to 20% of the purchase consideration. Depending on deal size, the risk profile, and negotiation mechanics, this can vary. For inbound foreign investment deals, as Aditya had pointed out briefly before, there are restrictions, there are regulatory limits on what you can put in escrow. You can put in 25% of the purchase consideration up to 18 months. In domestic deal, we see the time limit for escrow even go about till 24 months, which ties in with the indemnity claim period that we often negotiate. Now, in order to make these risk mitigation measures actually serve their purpose well, there are just a few key points to keep in mind. As in an escrow agreement, it's absolutely essential to specify the release mechanism. If you make it too dependent on either of the parties, you're basically going back to the square one, and the independence of that escrow is lost. We often have partial releases which are agreed on milestones. For example, if you don't have any claim in 6 months, the seller can get paid up certain portion and the remaining can continue. Sellers are often also given the right to dispute any claims before the money is taken away from the escrow in favor of the buyer. So, but very important to have this very clearly laid out in the escrow agreement. The other dispute we often see is who's going to get the interest paid. Mostly it's to the benefit of the seller. So important to have this legislated as well. To illustrate, in a recent deal, we have seen a buyer insist on a 15% escrow for about 18 months. This gave the buyer comfort that there is sufficient protection. This was for post-closing tax liabilities that would come up. So they were able to close the transaction very quickly. In a smaller domestic deal, we had a 10% holdback of purchase consideration, but the seller was understandably cautious. So we had enough mechanism and protections built in on how the holdback will be legislated. Now, in summary, the key is to negotiate clear terms on amount, release, duration, and have a good dispute resolution mechanisms to avoid any post-closing friction. With that, I'll hand it back to you, Vidushi.
Thank you, Aditi. I think now I will have to stop with my questions. I have a lot of questions from the audience flowing in. Let me see how many I can take up in this limited time. The first one, Aditi, is addressed to you. We spoke about arbitration, and the question is related to that. It says, should arbitration be the default dispute resolution mechanism? If you could
That's a
answer that
very
in short, we will try and take up as many questions as we can.
Definitely, Vidushi. That's a very interesting question from our audience. Arbitration is increasingly becoming a preferred dispute resolution mechanism, specifically in cross-border deals. But it's important to always consider the cons that it comes with. The main advantages of arbitration is that it gives you confidentiality, which is crucial for commercially sensitive disputes. You would prefer that rather than airing your dirty laundry. Unlike court proceedings, arbitration keeps matters private, protects reputation and business relationships. The other benefit is to appoint neutral arbitrators with the right sectoral expertise. For example, in a recent telecom tower disputes that we were looking at, there was an arbitrator which was familiar with the industry and could come up and resolve the rental issues much faster than perhaps a court could have done it. Arbitration, then the other thing the arbitration does is also tends to be faster than the traditional litigation mechanism and offers a sort of finality to the awards. However, like I said in the beginning, arbitration does has its downsides. It can be costly, which may not make sense if you have smaller transactions or less complex issues. Arbitration has limited appeal rights. So it's a double-edged sword. You sometimes want the finality, but the parties may also want the ability to challenge the award if the process has been done unfairly. So the idea is to examine pros and cons both and then decide what exactly works well for the particular transaction. With that, I'll
Thanks,
hand it over to
Aditi.
you, Vidusha. I hope that answers it.
Absolutely. Thank you so much for that. The second question I have is for Nitish. Nitish, how can change of control clauses in contracts be managed?
Yeah, thanks, Adeshu, for that. So, change of control clauses are usually one of the key areas that you would identify during the due diligence phase. These clauses, if they are not properly managed, can lead to contract termination, disruption of crucial business relationships, or even lost value post closing. So, it is important to ensure that the M&A team is correctly identifying these COC clauses while undertaking the due diligence early on in the transaction. While reviewing the key contracts, it is also important to keep in mind the contours of the transaction and then see if the COC clause is actually getting triggered or not. For example, we have seen that a COC clause may only be triggered when there is a change in direct ownership of the target, whereas the transaction is an indirect change in ownership. So a clause may not even be triggered, and you don't have to take any mitigating measures for it. So, keeping this in mind, a thorough review of the material, customer, supplier, lender, and all other key arrangements of the target should be done by the M&A team to identify if the COC clauses are present and what is the impact of the transaction. Are they leading to any termination rights of the counterparty or only require an intimation or a prior consent? Once this has been identified, the next step is to handle the risk. And the various ways of doing that will be that if this is really a key relationship and the deal may not even move forward or may not make sense for the buyer if that consent is not taking prior to the closing of the deal, the buyer may even require the sellers to approach such counterparty well in advance, even before negotiating the definitive documents, to take their in principle approval for the deal to go through. Now, where the relationships may not be as key, but still you would want to ensure that you are not in any breach of the agreements, you would typically have conditions precedent to the closing to require the sellers to obtain such consents from the relevant counterparty wherever COC clause is being triggered. So, just to sum up my response to it is important to identify these change of control clauses early in the due diligence so that they can be addressed properly as express condition precedent or prior consent to the transaction. This will definitely ensure that the buyers can ensure business continuity and avoid major risks post the transaction closes.
Right. And like you rightly mentioned, Nitish, because it's a third party dependency, it becomes tricky. So it's better to start the process as early as you can to ensure that it's timely done. Thank you for that.
Yes.
Aditya, next question is on regulatory delays. So the question is, how can buyers mitigate regulatory delays and approval risks? If you could throw some more light on that, please.
Yeah, no, that's an interesting question. In Indian M&A, regulatory delays can actually derail well-structured deals, affecting timing and certainty both. So we typically recommend a three-part strategy. One is, planning early. So by identifying all regulatory approvals during the diligence process and not post signing is quite critical and puts you in a good place. So, for example, in a tech sector M&A deal, the acquirer was a Chinese, Singapore-based company, but again, one of its major shareholders was a Hong Kong listed entity with substantial Chinese state ownership. Now, despite the immediate investor not being from China, the indirect link triggered the PN3 scrutiny. Now, because we had anticipated this, we built in a couple of measures. One, closing condition tied to the FDI approval, rights to extend the long stop period, reverse break fee in case approval was not granted, and detailed disclosures and representations to manage counterparty concerns. This actually helped us keep the deal alive. Um, I would say secondly is structuring smart, and if timing is a risk, as Aditi mentioned, using a staged investment or a bridge instrument. You could also look at splitting signing and closing with appropriate long stop periods. Or, like I mentioned earlier, use Indian partners or co-investors to negate FDI approval requirements. Thirdly, I would say contract for uncertainty by setting up realistic long stop dates, including appropriate extension mechanics, whether one party or you need mutual extensions is quite critical to think about. Using conditions precedents to manage any closing risk. And I would say escrows and reverse break fees also help. To sum it up, I would say regulatory timelines in India are like the monsoon. They are coming, but not when and how wet things will get. So it's always good to start early, build some cushion, and expect surprises. I hope that addresses the question. Happy to elaborate further if needed, but back to you, Vidushi.
Thank you, Aditya. Very interesting analogy of monsoon. And right now, monsoon is on. It's raining. I hope all the regulatory approvals also keep raining. The next one, Aditi, I think we were talking about different types of due diligences, and the next one is on how can ESG and reputational risk be assessed and managed.
Thanks for that question, Vidushi. I think in today's M&A landscape, ESG is becoming very essential. The risks that run with ESG are deeply interconnected. ESG issues can trigger post closing reputational damage or issues from stakeholders, which can impact the deal value and the long term success of any asset that a buyer purchases. So, at the risk of sounding like a broken record, the key step is a dedicated ESG diligence alongside the financial and forensic checks. It's important to not just do the traditional diligence, but get on ground, verify details, have a dedicated team. In terms of checks, you would review the government environmental compliances such as pollution control, waste management. When it comes to assessing social factors, it's important to put focus on labor practices and community relationships to ensure that you are flushing out issues like child labor being involved or minimum wages not being paid out. It's important to then evaluate governance structures such as anti corruption policies and evaluating the board oversight. It goes hand in hand with checking compliance under various laws in India, such as Environmental Protection Act, labor regulation, CSR mandates under Companies Act. The other element is important to do a reputational due diligence by scanning the media and social media for any negative publicity, interviewing key stakeholders, and in fact, reviewing past litigation or regulatory probes on ESG aspects. One of the key examples which I remember distinctly is a couple of years back, we were doing a diligence of a unit, manufacturing unit, and based on forensic search of various articles, we found out that there have been protests against the air pollution emitted by that unit. It was helpful to identify it very early in the transaction and then get the right diligence done to ensure that the unit is actually functioning within the norms. So otherwise, it could have really hurt the buyer's value post closing. I think just to summarize, because we are limited on time, it's to simply put that ESG actually is, think of them, the ESG risks as, surprise guests that you get at a wedding. Important to spot them early, otherwise they can steal the show by taking over the mic and singing songs that no one wants to hear. Back to you, Vidushi. With that, I hope I answered the question.
Thank you, Aditi. Very interesting. I am conscious of time, and let me take one last question. Nitish, if you could address the question, which is what are common gaps in Indian sellers' compliance documentation?
Sure, Vidushi. So this is a frequent issue that we encounter in Indian private M&A deals. There are usually we've seen during the due diligence phase that there are significant gaps in sellers compliance documentation. So these gaps, why it is important to catch them early to ensure that they don't create any uncertainty for the buyers post closing. So just to throw light on some of the common areas of these deficiencies, one being the maintenance of statutory registers, returns, records, making due filings with the governmental authorities. This is a common problem, especially in unlisted and family run businesses, that they do not maintain or update their statutory registers, which are required under various applicable laws. So, this can result in incomplete records of the shareholders, directors, their past share transfers, and this can really make it challenging to really review their historical actions, and of course that can lead to statutory penalties as well. Another area of lack of proper documentation that we have seen is in terms of the employment records. We've usually seen that employees or contract labor is hired without having proper formal documentation. The registers and records for payment of wages or making provident fund contributions are not properly maintained. And past disciplinary actions or terminations or redundancies have been done without having proper documentation. These kind of gaps can lead to claims in the future. It can lead to regulatory penalties, which are definitely avoidable. There are also frequent shortcomings in terms of their contract documentation. Sometimes material business arrangements are done without having proper documentation in place, only on PO basis. Sometimes not even on a on basis of a PO also, but basis oral understanding. So there is a lack of clarity in terms of key terms relating to those arrangements, and this can make it really difficult to verify whether those contracts are even enforceable, and this can also impact business continuity post acquisition. So in some most of these common gaps in documentation require diligent review and identification of these lapses to ensure that the buyers have proper mitigation of these, and this can ensure that there is a smooth handover of the target post closing of the transaction. Yeah, I hope that answers it.
Yes, thank you so much, Nitish. I will have to stop taking more questions here. There are a number of more questions, and I assure our audience that we will address those right after the session. So please bear with us, and we will get back to you. And thank you all, Nitish, Aditya, Aditi. This entire session was very enlightening. I have a lot of takeaways, and just to pinpoint the key takeaways is that we have to start early with the due diligence process. A holistic due diligence has to be conducted for ESG, for financial diligence, legal diligence, reputational diligence, and whatever risks come out of that diligence, we have to ensure that we actually document those properly and take care of those issues so that it does not come to dispute. And even if dispute arises, we have to ensure that our documentation is well drafted to lay out all the details of the dispute. So thank you so much for this lovely session. And before closing, I would like to ask each of you in the audience to respond to the poll slide on your screen to provide your feedback on today's webinar. We take this very seriously as part of our continuous improvement program. Prajay, can you please put up the poll slide? Thank you everyone who participated in this poll. It's very, very helpful for us to ensure that we keep improving our programs. Finally, I would like to thank our speakers for sharing their expertise and experience with us today. You were simply outstanding. Thank you so much. Also, thanks to you, our audience, for your attention and your questions. I hope you found the webinar interesting and a worthwhile investment of your time. We certainly enjoyed bringing this to you. After the webinar, we will send you a copy of today's presentation, materials, summary notes, and a link to the webinar recording. You'll also separately receive a request for your feedback on the webinar. Please take the time to send us your feedback, comments, criticism, and even compliments. The form takes less than 1 minute to complete, so please do take out the time. If you are interested in in-house training or any other matters arising from this webinar, please do not hesitate to contact us. Our contact information is on the contact slide at the end of the webinar. Thank you for your attendance today, and we look forward to being with you again in M&A Academy. Thanks a lot.
Thank you.
Thank
Thank you.